Good afternoon, everybody. Good afternoon. Good afternoon. This is Stephen Paternack with the Paternack Real Estate Team, and this is episode 2 of Mortgage Matters. For those of you that were with me last week, we dove into interest rates, which seems to be a hot button topic, that really affects your transactions that are happening in the moment. What I want to do today is I want to dive a little bit deeper into what actually moves those rates and the factors that really affect why those rates are moving where they do. So today we're going to talk about a recent sales report that came out. We're going to talk about 10-year yields, and then we're going to kind of get into some creative ways for you to make the mortgage a little bit more affordable. So, as always, I am joined by Christian Babcock, who I am going to enter into the stage right now. There he goes. What's up, Christian?
How we doing, Steve?
I'm doing good, my friend. How are you?
Good. Hanging in, man. Hanging in.
All right, we're back. Episode 2, buddy. Here it is.
All right, here we are.
We were talking, you and I were talking about different ways to engage with people, right? And I think that just the two of us just committing to doing this, right?
Mm-hmm.
Our goal is to do this every single week. Obviously, life happens. We're going to do our best to try to do so. But I really appreciate you being here today because, you are my go-to when it comes to mortgages and the financial industry. Like when we're talking and you're talking about mortgage-backed securities and this, that, and the third, I'm just like, all right, time out.
Doesn't have to be that complicated. Come on, you're a prep alumni, man. You know this. You went to Sleeponomics.
So when I actually, like me personally, dude, like I choose what I allow in my bandwidth. You know what I mean? So, when people ask me about these sort of, financial questions, like, okay, so what is this? I'm like, all right, I'll tell you what, I'm going to put you on the phone with the expert, right? I could tell you as a real estate agent and salesperson and broker if I think this is a good deal. I can tell you from the aspect of an investor, will the property make money? I could tell you how to manage a property. Those are things that I'm an expert in, right?
Sure.
But when it comes to the financial world, I don't claim to be an expert, and I don't necessarily want to be. And that's kind of why I want to have you here with me,
No, I hear you. And that's why we have, people have, are professionals in their space. That's why we have lawyers, we have accountants, we have real estate agents. As a real estate agent, and even to do my job, though, we do need to know, a little bit about everything. I need to know, especially since we're handling, contracts and everything else. I don't need to be a lawyer, nor would I pretend to be one. But, I definitely know how to read a contract for a house. I know what the contingencies are and what they mean, the timing and all that stuff, and I can speak to it. Same thing. I have to be a little bit of an accountant. I need to know how to read tax returns. I know how to decipher tax returns. You have different ways people are paid. But I'm not an accountant. I don't do taxes, but I know how to read them.
Yeah.
So same thing with you. You need to know enough to be able to educate your clients. And I'm really happy that we're putting this together because we put our heads together and certainly get some good information out there. So thank you again.
Yeah, and look at how long of a way we've come. Do you remember when we did this like during COVID? And I would call you up like, all right, Christian, let's go live right now. And you're like, all right, cool. What are we gonna talk about? Look, we got banners. We're live on on our social media, so that way other people could see. It's just a natural progression, right?
Yeah, no, it's good stuff.
Okay, so the first thing I noticed when I checked my inbox today was I got a email from you, and as I do every single week, and it was talking about different reports or whatever the case may be, but your mortgage newsletter that comes out every single week. Can you just speak a little bit to the purpose of that and who that goes to?
Yeah, so I send it out to my realtor partners. It goes out to your office, and then they blast it out. But I do have a lot of other agents and attorneys and clients that newsletter goes out to. And it really just gives a recap of the week. Like what and again, and I say this to my clients all the time. When it comes to mortgage rates, mortgage rates are always reactive. We can't it's very hard to be proactive unless you can, they always say, unless you have the crystal ball, to know, what rates are going to do, and we don't, we know when, we have the economic calendar, we know what reports are going to come out. There's forecasts, there's speculation on how they're going to come out, but then once they do come out, the market reacts, and the stock and bond market react to the same reports. And mortgage rates are very sensitive to that. So, so the newsletter is really a recap of the week. It comes out, I put it out on Fridays. This week's, big report that really had rates, spike was the retail sales report. It came out much stronger than expected. They're saying it can, the American consumers proving to be, resilient is the word that they're using, meaning that they're, still, even with high interest rates on credit cards and car loans and mortgages, still spending money. Which is causing, inflation to be persistent, and causing, mortgage rates to continue to gradually go up. Sometimes it's a little more than gradual. Sometimes it's a pretty fast spike. But it's just, showing that high rates are probably going to be here for a little longer than we'd hope or want. So.
All right. So hold on. I want to try to break down a lot of that because. So just so that, because again, I like to just make sure that everybody can understand, and specifically myself. So I kind of want to just backtrack a little bit. You had said that there are economic reports that come out on, you have an economic calendar, first of all, right?
Right.
So who puts out this economic calendar? What is the economic calendar? What is that?
Well, it's just like when different economic reports are scheduled to come out. You have inflation reports, you have jobs reports, weekly jobless claims, monthly, unemployment rate figures, GDP.
Gotcha. Okay.
All different things that that Wall Street watches, and the globe, not just Wall Street, but economists, and to see how healthy the economy is or unhealthy the economy is, and which kind of direction we're going.
Gotcha. Okay, so hold on. So these reports, yeah, dude, I just want to. All right, economic reports come out, right? And these reports tell how healthy or unhealthy the economy is. Perfect.
Right.
All right.
Pretty much.
Now, and then when those reports come out, the stock and bond markets react to that.
Right.
So
exactly.
What exactly? So give me an example, right? So retail sales, whatever, showed that they were strong, right? So stocks, how does that affect stocks and bonds?
In a normal world, it can affect them, like you can almost predict how they will impact them, where if something comes out stronger, you can see, a rally in the stock market and the sell-off in the bond market. They usually kind of work inverse to each other. Institutional investors or, even private investors will look at treasuries as safer assets, because they're backed by the U.S. government, so they look at treasuries as a safe asset. So when you see, a lot of times, uncertainty in the economy, you might see, a drop in the stock market and a rally in the bond market, and then, depending on what's going on there, yields on treasuries and mortgage-backed securities will rise or fall, which is what will cause mortgage rates to go up and down, so it is really very fast. Sometimes it can be very fast. We'll get, the market opens, we start seeing trading at 8:30 on, mortgage-backed securities in the morning. And there's been some days it just opens up, wild, and depending on how volatile trading is going, we've seen even what they call interday price changes, where we'll get mortgage rates out around 9:30 in the morning after the market opens. And then we've had some days where we've had negative reprices, 2 or even sometimes 3 in the same day, because it's just, and then we've seen improvements also. Sometimes if it's going the other way, we'll actually get rates in the morning and then better rates by the afternoon, So it can be very frustrating from a consumer's standpoint, because you could speak to someone, a lender on Monday or even in the morning, and rates could be different in the afternoon. So when people are, quote unquote, shopping around, unless you're literally talking to like 3 different lenders almost at the same time, you're going to get 3 different answers if there's a lot of volatility. There's just been so much volatility. It's really just trying to catch a dip on the right day and lock somebody in with enough time to close. So it's been a very interesting year.
I had a situation recently. I was working on a commercial deal. Actually, it's so this is a commercial lending, which is obviously similar but different than the residential rates. And it's interesting, you had mentioned that people, consumers are frustrated because, like, literally the buyer had gotten a quote from them
Mhm.
2 months ago, and then you have 30 to 60 days of due diligence. It's a little different on
Right.
commercial, and then the bank came back to them and retraded them,
Wow.
and the rate is completely different, and the terms were completely different
Yeah.
than what they had originally
Yeah. Yeah.
originally received their original letter of intent, or because that's
Mhm.
in commercial world, it's like, okay, we're going to give you an LOI,
Right.
and
Right.
then from there we'll do the due diligence, and then like they retraded them. And
Mhm.
I see that in the resi world too, right? In the residential world, because it's like, all right, if you don't lock your rate in,
Mhm.
depending on these reports that come out and depending
Right.
on the effect of the stocks, and your rate can be, such a different number than what you thought it
Right.
was going to be.
Right. And coupling that then with how business is done in New York makes it even harder because in other states, contracts are drawn up, and when you're when you sign a contract for to buy a property in other states, even Jersey and Connecticut, you have a defined closing date in the contract. So it's much easier to say like, okay, you're closing in 45 days. You have to close in 45 days, so we can lock your rate in for 45 or 60 days right at origination. In New York, you have, an on or about closing date,
Uh-huh.
so we don't know when you're closing.
And
I
then you got
literally
time
just,
of the essence. And then you got time of the essence.
well,
So
time the essence comes if you're really dragging it along. But my point is like,
yeah.
you're really at the mercy of the seller and, on a New York transaction, which, right before this call, I was actually speaking with, another agent about a deal that we have in process, and I'm trying to get, a rough idea as to when the seller wants to close, especially this time of year. We start pushing up against the holidays. I've had experiences in the past where, we're already locked, we're clear, and then the seller just decides, what, I want to stay in the house for Thanksgiving and Christmas, and didn't tell anybody until like we're clear to close, and we get pushed into January. So it's very frustrating to lock a rate and have enough time to close. Is my point in New York. So it makes it, it just adds an extra layer doing business in New York. And if you're dealing with a lender that's not experienced or in New York, it could be expensive.
Yeah.
So,
Yeah,
you know,
yeah, yeah. Wow.
so
So they got clear to close, and the seller turned around and said that he wanted to stay in the house for another 2
yeah.
months.
Oh yeah, yeah. I'm just not ready to move, and
My first gut reaction is, all right, cool. So then we're gonna close, and you could pay me post possession.
that's happening more. Yes,
I
that's
would
happening more.
That would be my gut and my answer, my suggestion, I guess, without knowing the whole situation, to my buyer.
Right,
Like, listen,
right,
let's close, so that way, because we don't know where the rates are going to be. If you're comfortable with where the rates are now, if you want to gamble a little bit, then it depends
right,
on how lucky you feel. But
right, right,
um,
right.
yeah, it's
Right.
interesting.
That's again. There's a lot of moving parts when it comes to this. It's not, you're not. It's not like finding a pair of shoes at a 10% discount and getting a pair of shoes in 24
No.
hours. There's so much that goes into it behind the scenes if you're doing it right. And you want a good experience. So
Yeah. Well, for me, and I think I said this last week, but like for me, and yes, it's about getting the transaction done, but it's also just about making sure people don't have buyer's remorse,
well,
right?
right,
And
right, right.
and building good relationships with people. So if you come from that sense of value, and I think both of us do,
Mhm, mhm.
it's really important, because a lot of agents just out here, and loan officers too. We were just talking about on the phone about,
Yeah,
certain people, you just kind of get the a vibe from, and you're just like, listen,
yeah.
this person is not out for my best interests.
Right, right, right. Well, unfortunately, that those, yeah, in every profession, those people can exist. So we just do what we do, and that's what we look out for each other and look out for our people. And that's why we're in business. That's why we're staying in business, is because doing the right thing for 20 years. So
All right. So I just want to go back. All right, okay, cool. So reports come out, stocks, and then it hits stocks and bonds. And then from there, it then trickles down to, I guess, what, the 10-year yield, right? Is that something that you're looking
and
at?
your treasury yields are one indicator as to where mortgage rates could be going. They do move pretty much in Congress with mortgage-backed securities, which is what we really affects mortgage rates or mortgage-backed securities. But from the consumer side, it's easy to find live trading at the 10-year treasury. It's always been like kind of a lead indicator for mortgage rates. So when you start seeing those yields going up, mortgage rates are likely going up. When you see it going down, mortgage rates are going down. So now we're at a point now where we're the yields are just about hitting 5%. It doesn't mean mortgage rates are 5%. Mortgage rates, are tipping the scales at 8% right now on 30-year fixed.
And hold on a second, is that because that spread is usually where the banks make their money, right? Or no?
No. That's a whole nother conversation. No.
Episode 3, we'll say that.
Right. But no, this is really just, again, more so, people, because I get that question all the time when I'm speaking to people and I'm talking rate, and they're like, where can I find this? And you really, we pay for subscription services to watch mortgage-backed securities trading, but you can find, 10-year treasury yields just on Yahoo Finance, or like you just pulled it up on CNBC, like you can just Google it and you can find, even, live trading, just like you can on I watch Yahoo Finance for watching which way stocks are going, and it's a live
Yahoo
feed.
still exists? Yahoo's still out there?
Dude, Yahoo's huge. Yahoo Finance
Really?
is, you have to check it out. Yeah.
Oh,
I'm not advertising for Yahoo right now, but they've been around forever. I still got my Yahoo email I use.
Oh my Lord, that's hilarious. That's hilarious.
It's not Hotmail,
Yeah, true. All right, so do me a favor, break down just a little bit here. So, I mean, listen, this right here kind of just flows similar to the chart of last week where, rates are up and then they're down, and now we're just seeing them go through the roof. So what exactly is the 10-year treasury, and what does this have to do with interest rates right now?
They're bonds, they're bad bonds backed by the, U.S. government, so, and they pay a yield, based on that security, so they're investments, you can, it's like a stock. They're safer investments than stock. They're less volatile, and they're guaranteed to pay interest, so most people have them in their portfolios or 401ks. You don't even necessarily know that they're there. But,
so this treasury right here, they're paying you 5% or 4.9% to invest in the United States government, essentially.
Right. Essentially, right.
And what does that? All right, it's cool. So I'm going to invest. So if I had whatever X amount of dollars and I wanted a safe investment, I would turn around and say, okay, you know what? I'm cool with the 5% return. I'm going to invest in these 10-year treasury bonds, right? That's what they are. They're bonds, right? And what does that have to do with interest rates? And how does that, and why is this a lead indicator for interest rates?
It's a lead indicator really for, inflation more than anything else. And that's what mortgage rates are sensitive to, is inflation, and that's why we've been talking about inflation in terms of, where mortgage rates are going, like we talked about last week. So, again, it's just really, one indicator that a consumer can look at and find, what's going on. It's not gonna, again, you're not gonna be able to look at this and say like, all right, based on this, my mortgage rate is that, but it's just a way to show which direction they're kind of going.
Gotcha. All right. So for your average consumer, like, even though, it seems really like a great time to invest in the United States government, it's not necessarily a good time for people if they're trying to invest in housing.
Right.
It's crazy how that works.
Yeah.
Now,
one of the things that I know we want to talk about is, essentially how, creative you can get in terms of, saving money when rates are high. We've talked about, before, a lot, the conversation that I continuously have with people is, if you can afford to buy now, still a great time to buy now. There's a lot, there's not a lot of inventory, so it's hard to buy now. But, it's, and the historical chart that you showed last week was really good too, to kind of put it in perspective. In fact, I had a conversation with somebody this morning that had, has been in my old neighborhood, in Yonkers. They're selling their house. They've been there for 40 years. And we had that discussion. I was like, oh, you bought your house 40 years ago. So would you have a rate like, 17%? And he was like, actually 12.5. So, and he said, he's, currently, he probably bought the house 40 years ago for under $100,000. He's selling it for $850,000, and he's still got $130,000 mortgage left, and, he's retired, but it was a very interesting conversation because,
he must have refinanced. He must have refinanced
a million times. Just like, like I said, like last week, just like my parents refinanced a million times. Put his kids through private school. Consolidated. And every time rates went down, we made, we pivoted. We made another move. We refinanced lower. You know, right now he's got 130,000 left on his mortgage. His payment's $860. So he's trying to, like, you know, now he's downsizing. So he's looking to still take a small mortgage. And we were actually matching up how much he should borrow based on keeping the payment exactly the same.
Yeah. Given the rates, which is probably a fraction of what it was, you know, just a couple months ago.
Yeah, totally.
You know, I probably could have borrowed 400 grand a couple months ago, and that now probably only equals 250 grand. Like 120. Look at that. Yeah. Oh boy. So you started going into the whole buying down points. What exactly is buying down points?
Right. So
what does it mean, and is it good or bad?
So buying points, you know, it's not, I wouldn't say, even preface it as saying good or bad. They are, you know, they're a means to buy down the interest rate and pay less money over time. You know, so, you know, a point is the equivalent of 1% of your loan amount, right? So, you know, that's what it's called. 1 point is 1 percentage point. 1 percentage point, right? So if you have a, you know, $100,000 loan, it's $1,000 for the point, right? So, but, you know, the challenge is, you know, you don't get, and this, a lot of people actually confuse that with, you know, 1 percentage point discount on the rate. It's not, you know, so 1 point might only buy down the rate 1/4%, you know, with, you know, where the margins are, you know, and as skinny as they're getting right now, you know, on average, on a conventional loan, a point only really gets you 1/4% discount. So kind of play that out, you know, 1/4% discount on $100,000, you know, really, you know, goes down $17. You know, so
because it's $250, right? Essentially, more or less per year.
Right. I'll give you an example. So on $100,000 at, you know, 7.75, I'm just pulling that rate out of the sky, is, you know, the payment is $716. At 7.5, it's $699. Right. So that's at $17 less per month, but at the cost of $1,000 up front. So when you look at, you know, you take $1,000, you divide it by 17, that person it's going to take that person 58 months, 5 years to recoup the money they spent up front. So, you know, what I've been telling a lot of my customers is that because we are anticipating this, you know, we're praying for, I should say, this refinance boom, maybe in the next year, maybe the next 2 years, if rates go down 1%, 2%, if you refinance in 2 years, that way, the money's just gone. Like, you don't get it back, you know? So, you know, you paid the $1,000 up front to save 17, you never actually recouped it, you know? So, you know, on the flip side of that, so I'm recommending people don't do it unless they absolutely have to get the rate down to qualify. You know, that's a different story. But, you know, all things being equal, if they still qualify, I would advise, you know, going with the higher rate and not paying points, because again, you're not going to really recoup that. Now, I have seen, you know, lenders out there, and we talk about it all the time, you know, where, you know, those people will get estimates. I just had a lady the other day, I won't mention the company, you know, but it's, you know, she calls me up. You know, she didn't even have a contract yet. She just got an accepted offer on a co-op. We all know how long co-ops can take to close. Didn't even have a contract to sign, and locked in a rate with a lender, you know, which she said at 6 1/8 on a 15-year, right? So immediately I was like, you know, it doesn't sound right. So I said, how much are your closing costs? So the closing costs are $10,000. Now on a co-op, closing costs on average about $4,500 if you're not paying points. $4,500, maybe $5,000 all in, like lien search, like, you know, everything. So she was overpaying by about $6,000, and it was only like a $200,000 loan. I don't think it was that much.
Yep.
So without even seeing her estimate, I knew there was like 4 points in there. You know, and I asked her, did they explain what that is? No. Did they do the math with you to tell you the difference? No. All she knew is that she got a low rate. You know, and that's all she, you know, and, you know, that's all she cared about. So, you know, it's just not, in my opinion, the way to do business, you know?
So buying down the points, but is there a situation where it makes sense that would only be like if I got clear to close, and The only thing I can't do, I can't afford to. I'm not going to qualify or something. Like, where is it? When is it a good point?
Well, again, it depends, and that's why it's not a clear, like, on that's why I say on average, a point gets you a 1/4% discount on conventional loan. But different types of loans, like if you price out an investment property, if I price out this, sometimes a point can get you as much as a 0.5% discount on the rate. Like I've seen that, fairly recently because they're, the rate sheets are kind of all over the place. So, so it could make sense for one person, not another. In some cases, when I'm locking somebody in, I'll give them like multiple different options because sometimes the next rate down is only a fractional point, might only be a quarter or, a few $100s or whatever. And if that can
Mhm.
save them some money, but again, if they can break even within a short window of time, that's what'll help them make the decision. And I've had people even, not take my advice and say, I just want to, I want to pay the point, I want to pay 1.5 points or
Yeah.
whatever else. I just want my payment here, even if I refinance in the future. Because, again, we can't guarantee that rates are going to go down in the short term or in the future, so nobody can guarantee that. People are speculating, sure. But, so there are those people that just want to play it safe and say, you know what, I'd rather spend the money now, keep my payment where I want it now.
Yeah.
If
Yeah.
I refinance, I'll deal with that then, so.
For me, I always look at every dollar I spend as an investment, whether it's an investment in my time or an investment like this. So if it was me and I'm like, all right, I'm going to spend whatever, 5 grand, and it's going to save me, whatever, $25 a month. It's going to take me forever to recoup that money. The example you gave is perfect because that's how all people, I think, should look at when you spend money. And
Right.
it's
Well,
just
especially when it's
sad
your
that
money
people.
in the bank, especially now, like you can put money into a high yield savings account or, a CD that's making more than 5% interest, right now. So, even if you just took that money and had it in a savings account, it can, A, you have it for a rainy day, but B, it could be growing somewhere else. So, but that's it, like having that money, like you can do the same thing. You can, basically pay an extra, $17 a month for the next 5 years if you want to just, have, but you have that money, you have that money, So I look at it the same way. Now during the refi boom, just a couple of years ago, and when rates were in the twos, I was actually, I wasn't necessarily recommending the buy points then, but what I was saying, it was like maybe not a worse idea because you're never going to refinance that loan unless you move or die, like that, so people
Yeah,
with those two and a
very
half
true
percent,
because the rate's so low and you're not going to
right,
refinance it. Right now, they're high. So
right,
it's like at some point, your goal is
you're
to get
gonna,
out of this 7,
right.
8% loan that you're in.
Right. So that's why, like when people were refinancing or buying during that time, even though the rate was stupid low to begin with, 2 3/4, 2.5, a point could maybe get you 2.25, 2% flat. I mean, some they went down like super, so for that. And then my question was, how long do you think you're going to keep the house? Not when you think you'll refinance, how long are you going to live there? You're going to
Yep.
live there for the next 20 years. Fine. You're going to break even on the point in a few years. You're saving money in the long
Yeah.
term.
Yeah.
You're never
Yeah.
going to touch the mortgage. Go for it. So it's
It's
just,
it's hilarious. It's hilarious to me that you ask a lot of the same questions that I ask buyers as well. I always ask them. I say, "All right, so what's your plan? Right? Are you moving here for 3 to 5 years, or are you going to be here 7 to 10, or are you staying longer than that?" And
right.
from there, I'm able to kind of advise them and give them different sort of scenarios as to where to buy, how to buy, and how to put the
Right. Right.
transaction together.
Right. Some people are buying, and they know they're not staying there forever. They might be looking at it as a stepping stone property. They want to make some money, move on to something bigger. They can't afford the big house now, but they do want to still be in the market, so they'll buy something else and and trade up later. Everybody's scenario is different, and I always use my
Mhm.
personal experience, in those conversations to try to help people like relate. I try to relate to people using my own example of how I've, bought my house and why and and all that stuff and how long I'm staying and so it well yeah, I mean we got to ask the same questions, sales and being in our business, you have to ask questions and then you have to listen and then based on what you hear when what they tell you, you give them what they should be getting, and I
You
think a
know what
lot
I
of
tell people all the
people
time, and I was taught by the nuns when I was back in grade school: 2 ears, one mouth. God gave you 2 ears and one mouth for a reason to listen
right,
twice as much as you speak.
right, 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 right. But that's a lot of salespeople in different industries, they spend too much time trying to sell and not actually listening to what the client's telling them, and they and that's where they lose track. And people lose confidence in you when they think you're not listening to them. You're just trying to force something on them that they don't want, that they did not asking for. Yeah.
Well, the other flip side to that is that if you're not doing your due diligence, like, for me, like, I look at these, these calls that I have with you, and this is why I kind of wanted to go public about me. And I've told you this numerous times, like, I'm educating myself so I could be better and give that advice when people are talking to me and when clients come to me. A lot of people out there, in whatever industry they're in, they're not actually students of the trade, and they're not really learning how to even advise people, because your average agent, they're like, oh, what's going on with rates, or how's the market, and they don't really have an answer because they're not studying it, and
Right.
and so different people in different industries, you and I think are aligned in this, is we have to be students of our craft so that way we can advise the clients the best way possible.
Absolutely. Yeah.
Man, all right. So I've got we don't have to run through all your phone numbers like we did last week. On the bottom here, I've got all your contact information there.
Okay.
You have anything you want to add to this, or are you good?
I'm good if you're good. I mean, like I said, you and I could probably talk all day, but yeah. So, but it's I mean, it's real. You're never going to lose in real estate. I mean, it's been proven time and time again. There's always going to be dips in every market, but when you look at a trend line, it's always gone in one direction. Again, we had a major recession, in the last decade that, where we saw a big dip. Nobody that I'm seeing or reading is calling for that kind of drop. The market will eventually level off. I think locally, we still can see another 5 or 10% appreciation in real estate just because of supply and demand. And if there's a correction, it's not going to be a drop, so, and again, I always look at when you're buying your first home that you're going to live in and stay in with your family and send your kids to school, you never have better security than owning your own home. You never be pushed out. Somebody can't just arbitrarily jack up your rent, make it unaffordable. And buying in this market in a high rate environment, you will only make your situation better later. And that's what we're talking about with the refinance. Like, if you consider the fact that even if your income moved in, and it went up on average, even just 2 or 3% per year, but then your mortgage rate is either steady or goes down in the future, you're in a better position, than just renting for the rest of your life.
Yeah. Well, listen, the whole renting aspect, paying somebody else's mortgage is just, I don't want to say it's silly, because a lot of people don't have the options to be able to purchase something, but it's something that you should always seek to get out of as soon as possible. Like, even for college graduates and for people that are just, starting out their lives. Like, I think you bought a co-op, right? One of your first purchases was a co-op, right? And you were able to kind of steadily increase to get to the point where you are now.
I had two. I had a 1-bedroom. I sold that one into a 2-bedroom, and then I bought my house. And I made money on both of them. I didn't kill it. I didn't make millions on them, but I didn't lose money. I made money on both. And then I bought my house. So, but even just for the security of not being able to be pushed out of where you live if your landlord just decides to sell it or whatever. Right, happens all the time.
Peace of mind. Yeah. All right. So listen, Christian, I'm gonna be in touch, and hopefully next week we'll be able to jump on and get back into this. I truly, truly, truly appreciate your time, man.
All right. Thank you, man. I appreciate it.
All right. Take care, man. Bye-bye.
All right, you too.